Chapter 5 Contract Bonds, Sec. 100 Scope. Nowadays nearly all contractors are required to give bond with corporate surety for the faithful performance of their contracts, and those bonds form one of the largest, and at the same time, one of the most hazardous classes handled by surety companies. Bonds may be required for the performance of any kind of contract, and all such bonds are within the scope of this chapter, yet bonds for building or construction contracts are the kind most frequently needed, and with which we are principally concerned. In connection with a contract, three different bonds may be required, namely, the preliminary or bid bond, which guarantees that if the contract is awarded to the principal, he will sign the contract and give bond for its faithful performance; the construction bond, which guarantees performance of the contract; and the maintenance bond, which guarantees the durability or efficiency of the work. In some cases, a separate bond to guarantee the payment of bills for labor and materials is required, but that liability is generally covered by the construction bond and will be discussed under that head. Sec. 101. The underwriting of bid bonds. In case the principal in a preliminary or bid bond should fail to comply with the condition of the bond, the owner will award the contract to the next higher responsible bidder, or if there is none such, will re-advertise the contract. The maximum actual liability therefore will be the difference between the bid of the principal and that of the lowest acceptable bidder other than the principal, but in order that application for these bonds may be acceptable, it is not enough that the applicant has sufficient resources to stand this difference. It is considered bad policy for a surety company to sign the bid bond unless it is also willing to sign the construction bond. The premium is nominal, so that nothing would be gained and much might be lost, and it is also bad policy to issue the bid bond on the assumption that an investigation to be made thereafter will prove satisfactory, as the surety may find itself practically compelled to sign a bond for an unsatisfactory contractor. As a rule therefore, preliminary or bid bonds should be issued only where the company is willing to sign the construction bond in case the contract should be awarded to the principal. Sec. 102. The underwriting of construction bonds. We now come to the consideration of what is ordinarily termed a contract bond, viz., the bond guaranteeing the performance by the principal of the terms of a contract for the construction of a building or other work. In considering the underwriting of such bonds, we will follow the plan that has already been adopted of treating the subject from the two standpoints of the personality of the contractor and the character of the contract. Sec. 103. The personality of the contractor. In general, a contract bond is broader than a fidelity bond. The latter is of a negative nature, guaranteeing merely that the principal will not commit certain specified acts. The former, on the other hand, is positive, guaranteeing that the principal will perform his contract. If an employee is honest, it is practically certain that his surety will not suffer a loss, but a contractor may be perfectly honest, yet may be deficient in ability, experience or financial resources to carry out the particular contract, and therefore, his surety may suffer a loss, notwithstanding his honesty. It is necessary therefore to consider the personality of the contractor from the following standpoints: his personal honesty and good intentions, his ability and experience to do the particular work, his plant and equipment, his financial resources, and the amount of work he has on hand. Sec. 104. Honesty and good intentions. It is not necessary or practicable to investigate the matter of the personal honesty of a contractor with the same scrupulous care that an applicant for a fidelity bond should be investigated. It is however necessary to be satisfied that he is a bona fide contractor, who intends to carry out his contract to the limit of his ability and resources, that he is a man of reasonably good personal habits, and particularly that he does not drink to excess, that he has been in the habit of performing his contracts satisfactorily, and paying his bills promptly, and that he bears a good reputation for honesty and integrity in the community in which he lives and with those for whom he has done work. And the importance of ascertaining these matters is not to be underestimated. Contract bonds are very hazardous and contractors should be carefully investigated from every standpoint. In this connection it is to be borne in mind that the statements of the men from whom the contractor has been purchasing his material and supplies are not always reliable. It has been found that when a contractor is heavily indebted to a dealer, the latter will often recommend him in order that the contractor may, out of the proceeds from the new contract, collect the amount due him. Before relying upon a reference from a dealer, it ought to be ascertained that the contractor does not owe him an excessive amount, and that the bill is not overdue. Architects, engineers and owners for whom the contractor has done work in the past can give the most reliable information, and whenever possible they should be consulted. Sec. 105. Ability and experience. There is such keen competition among contractors, and the successful ones work with such facility and economy, that there is little chance for the man who is not up to standard in ability and experience. A contractor must be able, not only to perform the work successfully but to estimate the cost accurately. If an inexperienced contractor meets competition in bidding, he will either make little, if any, profit, or will sustain a loss, and the surety for such a contractor is in constant danger of loss, even though the principal may seem to have ample financial resources. In the first place, there is the man who has really no experience as a builder, but who, as a carpenter or subcontractor, has acquired a few hundred, or perhaps a few $1,000s of capital, and with that and a lot of nerve, sets himself up as a contractor and builder, or as a general contractor. He will usually be satisfied to take contracts for ordinary residences, where he thinks no especial skill or experience is required. But having no reputation as a builder, he can get work only in competition with experienced contractors. In such cases, where bids are asked indiscriminately, competition is usually keen, and, in order for him to get the contract he must make a very low bid, and will therefore have to do the work economically. If therefore, the particular contractor has not the experience and ability necessary for the most economical work, he will not make a profit and may sustain a loss. When such a contractor and builder takes a contract, and before it is completed, gets others, he is apt to become so involved in debt that he cannot extricate himself, with the result that the loss falls on the surety. There are in fact many such cases among the records of surety companies, and it has been found that the percentage of losses on account of these contractors is very large. Lack of experience and ability is generally shown in one or more of the following particulars. 1. He is likely to underestimate the overhead and incidental expense necessary in carrying on business operations. He generally gets bids on the several portions of the work, takes the lowest bid on each portion, adds them together and considers that the cost of the building. He allows nothing for the contingency that the low bidder, who in all probability has no financial responsibility, may not complete the work at the figure for which he bid, and allows nothing for the many other contingencies that may arise and make the work more expensive than he has calculated. 2. He will figure very close on certain portions of the work because he thinks he can do some of it himself and thereby save expense. 3. Mistakes in estimates are apt to occur because, while large contractors have their figures checked by 2 or 3 different men, the small contractor relies solely on his own calculation. 4. It is seldom that such a man manages the work in an efficient manner. It really takes considerable executive ability to carry out in an economical manner even a small contract, and there are few of these small contractors who have that particular kind of ability, which can be acquired only by experience. They are likely to make costly mistakes and their men do not always work to the best advantage. 5. Many of these small contractors know absolutely nothing about bookkeeping and often keep no books at all. The result is that they cannot tell whether the work is profitable or how they stand financially. They simply go ahead with contract after contract, using the money from one to pay bills on the others, until finally they are forced into bankruptcy. The only solution of the problem of these inefficient contractors is for the surety companies to decline to bond them, but it seems possible, with the large number of surety companies and all the agents competing for business, for almost anybody who calls himself a contractor to get a bond. There are other dangers incident to bonding these small contractors, and those dangers will be referred to in the proper places. Lack of experience has also been noted in large contractors who undertake lines of work with which they are not familiar. There are specialists in the contracting business as there are in other lines of business and the professions, and, though a man may have ample experience in one branch, he is not necessarily qualified in others. And, if a man who is not experienced in a particular branch undertakes to compete with those who are, the result is likely to be disastrous to his surety as well as to himself. A man may, for example, be a good builder of ordinary frame or brick houses, yet not competent to build a monolithic concrete residence or a warehouse with reinforced concrete frame, or he may be competent to build almost any kind of house, yet not be competent to build a railroad or a sewerage system. It is important, therefore, to ascertain that an applicant for a contract bond is qualified by experience and ability to do the particular work in hand and to estimate accurately the cost. Inquiry ought to be made of architects, engineers and owners for whom he has done work similar to that in question, and unless their opinion is favorable, the business is generally undesirable. If he has not had experience in similar work, then he should not be bonded unless he has ample financial resources to pay for his mistakes. Attention is directed to the difficulties not only of doing, but of accurately estimating the cost of certain classes of work, as for example, the building of sewers, subways, tunnels, waterworks and dams, and dredging, where unforeseen difficulties, making the work extra expensive, are likely to be encountered. Sec. 106. Plant and equipment. In order that a contractor may successfully perform his contracts, it is necessary that he should have the teams, machinery, tools and other equipment necessary for economical work. It is important to ascertain that the equipment is modern and in good condition, for many losses have been caused by the fact that the jobs have been started with worn out or inefficient machinery or equipment, necessitating much delay and expense for repairs and oftentimes the purchasing or hiring of other machinery before the completion of the work. Where the work is at all difficult or requires the use of much machinery, the contractor ought to be required to give a detailed description of his plant so that it may be submitted to the company's engineer for approval. The engineer having the work in charge generally makes himself familiar with this matter and can give valuable information. So also can engineers for whom the contractor has done similar work. The foregoing remarks apply more particularly to large contractors doing difficult work, but it is also necessary for small contractors to have a plant. Any contractor worthy the name ought to have not only the usual teams and tools, but he ought also to have an office with a good stenographer and bookkeeper. The contractor who transacts his business on the street and keeps his accounts in his head, does not deserve to get a bond. Yet, there are many such contractors who seem to be able to get bonds without much difficulty. It is of prime importance that a contractor should be able to tell exactly whether his work is profitable and what his financial condition is at any particular time, and if he cannot do this he is not a safe man to bond. In general, it may be said that the man who has not an office, with a complete set of books and somebody to keep them, should be let alone by the bonding companies. Sec. 107. Financial resources. We come now to what is perhaps the most vital element in the making of an acceptable contractor. A man may be honest and he may have sufficient ability, experience and equipment to do a particular work, but if he has not sufficient money to provide the necessary labor and materials and to take care of a possible loss of reasonable amount, he is not a desirable risk. It is not possible to make a rule, applicable to all cases, as to the amount of money a contractor ought to have to justify a surety company in signing his bond. That will depend upon a consideration of all the other elements that go to make a contractor. But experience has shown that, even if a contractor is a desirable risk in other respects, he ought to have on hand, in money or in good assets on which money can be immediately realized, an absolute minimum of 15% of the total amount of all his contracts. And it is only with the highest grade of contractors that such a small amount is permissible. 18 or 20% would perhaps be a better average minimum, and in many cases, a larger amount will be necessary to make up for the deficiencies in other respects. This minimum is necessary not only to finance the work but to take care of the ever-present danger that the work will cost more than the contract price, and therefore the minimum ought to be had after all necessary equipment has been provided and paid for, unless, of course, the cost of the equipment has been figured in the estimate. In cases of contracts for sewers, subways, tunnels, waterworks, dams, dredging and the like, where the work is in its nature essentially hazardous, that is, where unforeseen difficulties, making the work extra expensive, are likely to arise, it is especially necessary that the contractor have ample financial resources. In such cases, it is suggested that the contractor ought to have financial resources equal to at least 20% of the contract price. The difficulty, however, is not to determine what financial resources a contractor ought to have, but to determine what assets he has and what those assets are worth as financial resources, that is to say, what amount of money can be realized on them to carry on the work and to take care of the loss. A contractor's assets generally consist of cash, stocks and bonds, real estate, equipment, supplies and accounts receivable. In order that it may be determined that an applicant has what he says he has, he ought in the first place to be required to sign a letter addressed to the bank in which the cash is supposed to be deposited, requesting the bank to give the company full information concerning the state of the applicant's account and of his dealings with the bank. Then the surety's representative ought to talk with the officials of the bank and ascertain not only that the applicant has in the bank what he says he has, but also his average balance and his standing at the bank, particularly his ability to borrow from the bank. Money that is not in a bank but supposed to be at the home of the applicant is usually imaginary, and should not be considered. The stocks and bonds ought to be exhibited to the surety's representative, and wherever practicable, they ought to be deposited in a safe deposit box subject to the joint control of the surety so that they may be used for the purpose of carrying out the contracts and for no other purpose. It may be difficult or troublesome to verify the ownership of real estate, but it is not impossible. And inasmuch as surety companies have so often been deceived by false statements as to the ownership of real estate, the matter should not be neglected. The first thing is to require the applicant to give the exact location of the property, and to state when and from whom it was purchased, or how it was acquired. It will then be an easy matter to go to the land records, examine the indexes and see if the supposed deeds are on record and if the property stands in the name of the applicant. If it is found that the property has been conveyed to him, then the indexes should be followed down to date to see if he has disposed of it or mortgaged it. It does not take a lawyer to do this. A few inquiries from the recorder, or one of his clerks, will enable the average man to follow the above suggestions, and, if followed, they will be found to be of the greatest service in discovering those who are attempting to deceive the company and get bonds to which they are not entitled. If the property is supposed to have been acquired by inheritance, a few inquiries at the office of the clerk of the probate court will generally bring to light a list of the real estate of decedent as well as the names of his heirs. If in fact the property was thus acquired, the land records should be examined for conveyances and mortgages by the applicant. It is at least possible to examine the tax assessment roll, and if the property does not appear to be assessed to the applicant, an explanation should be required. As far as the accounts receivable are concerned, the applicant should be required to give a list of them, with the persons or corporations from whom they are due, and give such other information as will enable the surety's representative to ascertain all the facts with regard to them. And this information should be obtained where the applicant keeps a good set of books and there is no evidence that they have been falsified. Considerable dependence can be put in them, and, wherever practicable, they should be examined. On the other hand, where the applicant keeps no books, or keeps an imperfect set and makes up his financial statement from memory, it is strictly important to verify each item. A detailed report from the mercantile agencies should, of course, be obtained. They are fairly reliable, but surety companies have so often been deceived by inflated financial statements that further investigation along the lines above indicated is deemed necessary. Having ascertained that the applicant has all the assets shown in his financial statement, it is next in order to give them their proper value. It is to be borne in mind that we are now considering a contractor from the standpoint of his ability to carry on the work and to take care of a possible loss. And it follows that the assets can be considered as valuable only to the extent that they can be converted into cash, either by sale or pledge, and to the extent that they can be applied to the liquidation of any liability under the bond. The stocks and bonds should, therefore, be rated at their actual market value. If they are not quoted on the stock exchange, due allowance should be made for the probable difficulties in finding a purchaser at what might be considered their fair value, based upon income. The real estate should be rated at its probable value at a forced sale. If it is improved city property in a good location, it would probably bring at forced sale about 70% of what might be considered its actual value based upon cost. If it is country property or unimproved property, whether in the city or country, it would probably not bring more than 50% or 60% of its value. The amount of any mortgages or encumbrances should be deducted from that valuation. Indeed, if property is mortgaged for a substantial sum as much as 50% of its supposed value, it is of little or no practical value in case of a default, and should not be considered an asset. Where the property is exempt from execution as a homestead, or where it stands in the name of the applicant's wife, or in the joint names of himself and wife, so that it is not subject to execution for his debts, it should likewise not be considered an asset. It is generally difficult to verify the ownership or value of country property, and unless there is definite and satisfactory information on both of these points, it is generally wise to ignore such property, especially if it is far from the home of the applicant and unimproved. The equipment may be very useful and necessary in carrying on the work, but generally represents little, if any, borrowing power and can be sold only at a very liberal discount. Due allowance, considering the age and usefulness of the equipment, should be made. Equipment of this kind can seldom be sold for more than half its cost, and often not for that. The accounts receivable ought to be separated into two classes: those actually due and receivable at the time, and those to become due in the future. If the former are due from responsible parties, they may be taken for their face value, or say 90% of face value. In investigating the latter class, it will often be found that the amount is disputed, or that it is necessary for the contractor to do certain work, or to wait a considerable time before he can get the money. All such matters affect materially the usefulness of the accounts for the purposes of the contract, and due allowance should be made. If there is a dispute as to whether or not the money is owed, or if the parties who owe the accounts are not financially responsible, or if payment will be deferred for a long time, or if there is any other thing that may prevent the contractor from receiving the money promptly, the items should be eliminated. In this connection, attention is directed to the importance of having the financial statement made up at a time when the contractor has little or no work on hand, as otherwise it may not reveal his true condition if he has other contracts on hand. His statement will not necessarily show his true condition, for while his cash and accounts receivable may, at a particular time, be in excess of his accounts then actually due and payable, he may nevertheless have a large volume of outstanding bills not yet due, and in fact, may not be able to complete the pending work for the contract price, and may therefore be behind when he seems to be ahead. It has often been found that a contractor, realizing that he will sustain a loss on a particular contract, will make a special effort to obtain other work in the same neighborhood in the hope of recouping his loss, or at least deferring his failure in the hope of future profits. And it has been found that although he made an accurate statement of his accounts receivable and accounts actually due and payable, and that, although his statement showed him to have ample resources, yet as a matter of fact, he was then practically insolvent. While it is necessary to have a correct statement of accounts actually due to the contractor and of those due by him in order to determine his available cash resources, yet it is necessary, in order to determine his real financial condition, to ascertain whether the balance to be received from the pending contracts, plus cash on hand, will be sufficient to complete the contracts and pay all outstanding bills, whether they happen to be then due or not, and leave a surplus. It is really only the surplus that constitutes the worth of the contractor, and inasmuch as estimation is necessary to arrive at a conclusion, a liberal allowance should be made for contingencies. It is a good idea never to allow a supposed profit on a contract to increase the contractor's assets. Investigation in this direction is to be made to see if his statement of current assets is to be decreased. It is hardly necessary to add that the liabilities of a contractor should be carefully considered, as they often indicate the weakness of his financial condition when it might otherwise seem to be good. One of the things especially to be borne in mind, is to see that he has ample resources in the shape of cash or good accounts receivable to take care of current liabilities, whether for borrowed money or for goods purchased. In other words, available quick assets must exceed current liabilities, regardless of the value of real estate and other slow assets. In general, it may be said that when a contractor has a large proportion of bills payable and accounts payable, it is a sign that he may be doing too much work for his resources, and that he should be carefully investigated. The fact that he has put a mortgage on his real estate may be a sign that his borrowing capacity is limited, and if he has been compelled to put a chattel mortgage on his equipment, it is generally a sign that he is pretty weak, and that it were better not to bond him. In suggesting that financial statements of contractors be verified, I am not unmindful of the possibility that the applicant will resent a suggestion that it is deemed necessary to verify his statement. There may be some perfectly honest men who would resent such a suggestion, as an aspersion upon their integrity, but generally only those who have made false statements are fearful of such an investigation. The experience of the companies is that where the statements are not verified, the assets often prove, in event of default by the contractor, to be fictitious. One company reports that, in making a partial examination into the causes of its losses during the year 1912, it found a loss of more than $37,000.00 directly attributable to false financial statements of principals. The president of this company says, "False financial statements still rob our treasury of enormous sums." The rule ought to be, and no doubt will sooner or later come to be, universal, that only those assets that can be verified both as to their existence and their value, will be considered in estimating the financial resources of a contractor. There is exactly the same reason for verifying the financial statement of an applicant for a contract bond as there is for investigating the past record of an applicant for a fidelity bond. We do not accept the statements of the latter. Why should we accept the statements of the former? It is a business proposition in which sentiment has no place. Sec. 108. The amount of work on hand. A man may be capable of building, economically, a certain style of house and making a profit at current prices, yet, if at one time he undertakes the construction of half a dozen such houses in different localities, where he cannot give his personal attention to each, the increased expense resulting from the lack of close personal supervision, may be such as to wipe out his profit or cause a loss. Then, too, when a small contractor gets a large amount of work on hand, his accounts usually become so involved that it is difficult to find out exactly where he stands. He may think he is making profit when he is not. It is important therefore to see that a contractor does not outgrow his strength. Assuming that he is honest and personally efficient, the amount of work he can safely carry on will depend principally upon his financial resources and the efficiency of his organization. Large contractors, who have an efficient organization, and who are in the habit of subletting large parts of the work and requiring their subcontractors to give bond with corporate surety, can successfully carry on work equal to 8 or 10 times the amount of their net resources. The principal danger is from the small contractor, who, because he handles a few contracts successfully, wants to grab everything in sight and at once become a big contractor. Such men, even where they fully measure up in other respects, should not be permitted to carry more than about 6 times the amount of their net available assets. Sec. 109. The nature of the contract. As we have already seen, the question whether or not a contractor can perform a particular kind of work will depend upon his ability, experience, equipment and financial resources. However, he may be able to do that work under some conditions, but not under others, and his success or failure may depend largely upon the terms of the contract and the conditions under which the work must be done. It will be the object of the succeeding pages to indicate some of the dangers that may result from the terms of the contract, it being understood that we shall not deal with the difficulties of doing different kinds of work. That matter will depend upon the ability, experience, resources, etc., of the applicant, and has already been considered. Sec. 110. Adequacy of contract price. There is always a possibility that a contractor will not be able to do the work for the contract price. Such inability may result from causes that could not reasonably have been foreseen, or from the inefficiency of the contractor, or from the fact that the price is too low, so low that the most efficient contractor could not do the work for the stipulated price. Theoretically, the contractor's assets will protect the surety against unforeseen dangers, and, as we have seen, inefficient contractors should not be bonded. But surety companies must also guard against the case where the price is really too low. This is essentially important, for many losses have resulted from this fact. One company reports that in making a partial examination into the causes of its losses during the year 1912, it found that, in the cases examined, nearly $65,000 was directly attributable to the fact that the principal S bid was too low. In case the contract is awarded to a particular contractor, without competitive bidding, about the best it is practicable to do is to compare the contract price with the estimate of the architect or engineer. If that comparison is favorable, it may fairly be assumed that the price is commensurate with the work. A man who has sufficient reputation and standing to get contracts without competition usually has enough experience and ability to estimate the cost of the work with reasonable accuracy, and common sense enough not to undertake the work for an inadequate price. If, however, it is a case of competitive bidding, the greatest care should be exercised to obtain the names of the other bidders and the correct amounts of their respective bids. This information can generally be gotten from the owner or architect. If other reputable contractors have bid only a little more than the successful bidder, the difference may be ascribed to the natural differences in different calculations, but if the successful bidder is much below the others, it is a sign that an error of some kind probably has been made, and that the bid is not commensurate with the work. And it is not always sufficient to compare the bid of the successful bidder with that of the next higher man, for he likewise may be in error. The comparison should rather be made with the general average of all bids. It is difficult to state what percentage of difference would be the probable result of different calculations, and what a sign of error, for circumstances alter cases. In general, it may be said that a difference of 5% would not ordinarily be a cause for alarm, but that one of 10% would be a sign of error, and, in the latter event, the bond should not be signed unless the contractor is so strong financially and of such splendid reputation that he undoubtedly could and would stand a loss of that amount, plus the possible loss from unforeseen calamities. Likewise, any difference between 5 and 10% should be a warning, and care should be taken to see that the contractor is able and willing to take care of the possible loss. As a general proposition, it will make little difference whether the contract is considered as a whole, and a definite price, in the aggregate, provided for all the work, or whether the contract is divided into a number of units, and a definite price provided for each unit. It is about as easy to calculate the cost in the one case as in the other, so the chance that the cost will exceed the estimate is practically the same in both cases. But contracts are sometimes let on the percentage basis, which means that the contractor agrees to do the work for cost plus a percentage, the percentage being compensation for the skill, experience, equipment, etc., of the contractor. This eliminates, to a certain extent, the speculative feature, and such contracts are more desirable, from a standpoint of the surety, than the ordinary contract, under which the contractor takes the risk of the cost exceeding the contract price. As a rule, such contracts are awarded only to the most efficient contractors, and, unless the percentage is so small as to be unremunerative, it is fair to assume that the contractor will complete the contract. The dangerous feature about such contracts is that the contractor is generally required to guarantee that the work will not cost, in the aggregate, more than a specified sum, and, if it exceeds that sum, he is required to stand the difference. It is very important therefore to ascertain that the amount of the guarantee is well beyond a liberal estimate of the cost. The real risk of the surety is in proportion to the possibility or probability that the cost will exceed the guarantee. If it is a case of competitive bidding, the amount of the other guarantees should be obtained and a comparison as above indicated should be made. Sec. 111. The payment of the price. A prospective surety ought to know not only that the price is adequate, but that it is to be paid in a satisfactory manner. In the first place, although calculations are generally based upon a price in money, it often happens that the contract provides for the giving of stocks, bonds, notes or other securities in payment for the work. In such cases, the risk ought not to be accepted unless sufficient securities are to be received to yield immediately, in money, the estimated cost of the work plus the profit, and the contractor ought to have a binding contract by which he can immediately dispose of the securities at a price that will yield that sum. This matter of disposing of the securities should not be left to chance or speculation, but a definite arrangement with a responsible concern should be made in advance, and this arrangement should not be conditioned upon the validity of any issue of bonds, or upon any other matter. All such questions should be determined in advance, and the arrangement should be absolute, so that the expected amount of cash can, under any circumstances, be immediately realized. If the surety should be compelled to complete the contract, he would not relish doing so for a lot of securities of doubtful value. In the second place, it is important that a proper percentage of the contract price, neither too much nor too little, be retained by the owner until completion. Enough must be paid during progress to enable the contractor, with the aid of his resources, to finance the work, that is, to provide the necessary labor and materials. At the same time, it is to be borne in mind that the percentage to be retained will, in the event of default by the contractor, be available for completing the work, and is therefore a margin of safety for the surety, the margin being in proportion to the amount retained. Some building contracts provide for the payment of a certain percentage of estimates to be made periodically by the architect or engineer in charge, the percentage varying from about 75 to 90. Others provide for the payment of stipulated sums when the work has progressed to stipulated points. Any such arrangement may be satisfactory, so long as the contractor never, at any time during progress, receives the full value of the work done, it being always understood that the greater the retained percentage, the smaller the chance of loss, provided enough is paid to relieve the contractor of embarrassment in financing the job. Sec. 112. Time for completion. No matter how efficient a contractor's organization may be, it takes time to erect buildings and other works, and before signing a contract bond, the surety ought to ascertain that the contract gives ample time to do the work and that provision is made for an automatic extension of the time in case the contractor should be delayed by causes beyond his control, as for example, by a general strike in the trade, by fire, tornado, or bad weather. This is essentially important and should never be overlooked, for, in many cases where there is a dispute growing out of a delay, the delay is the result of circumstances beyond the contractor's control. All such disputes could be avoided by making a proper provision in the contract or bond. In many cases, the contract provides for the payment of a definite sum of money daily as liquidated damages for delay, and care should be taken to ascertain that this sum is not exorbitant but represents the approximate amount of damages that will actually be sustained by the delay. It is not fair for the owner to make a profit out of the contractor's delay. All the contractor and his surety ought to be asked to do is to pay the actual damages suffered. The true amount of damages will ordinarily be the fair net rental value of the premises, and the amount named in the contract should not exceed that sum. Sec. 113. Liability in case of destruction of building by fire, or other cause during construction. It is the law of most of the states that in the absence of an express provision, a contractor is not released from his obligation to complete a building by the destruction of that building during construction, even by causes beyond his control, as for example, by fire. The surety on a contractor's bond does not, however, contemplate such a risk, so it is necessary to ascertain, either that the contract or the bond exempts the contractor from such responsibility, or that adequate insurance is taken out, payable to the owner and contractor, as their interests may appear. Sec. 114. Liability for personal injuries. A contractor is likely to be compelled to respond in damages for personal injuries sustained by employees or other persons in the course of the construction of the work covered by the contract. A number of the states have recently enacted workmen's compensation laws, which provide for a very strict liability on the part of contractors and other employers who are engaged in hazardous undertakings. These laws generally provide that the employer shall be liable to the employee regardless of the question of negligence on the part of himself or his employees. As a rule, the surety on the contractor's bond is not directly liable for injuries to employees. Yet the payment of such damages by the contractor would to that extent reduce the contractor's ability to complete the contracts on hand and take care of possible losses, and all contractors should protect themselves against this liability by taking out employer's liability insurance in an adequate amount and in a recognized company, and this is especially necessary in those states where the employer's liability or workmen's compensation acts have been recently passed. It is suggested that all contractors, though they may be doing only a small amount of work and that of a comparatively simple character, be required to carry liability insurance. In the case of an injury to a person not an employee, the owner as well as the contractor may be held liable for damages, and under many contracts and bonds the surety would be compelled to reimburse the owner for the loss. In such cases therefore, in the event of the contractor's insolvency, the surety may be liable not only to complete the contract but also to respond in damages for personal injuries. If the contract and bond provide for this liability on the part of the surety, the bond should in no event be signed unless the contractor is fully protected by public liability insurance. It is the duty of underwriters to look carefully into this matter of employers and public liability insurance, as liability for accidents is becoming a very serious matter. Sec. 115. Liability of surety for labor and materials. In order to satisfy the obligation of his surety, a contractor must, in the majority of cases, not only complete the work covered by his contract but he must also pay for all labor and materials that may have been used in carrying on the work, otherwise his surety may be compelled to pay for them. Indeed, the most frequent element of default on the part of contractors is, not in failing to complete the work, but in failing to pay for labor and materials. The liability of the surety arises in this way. Nearly all of the states have made provisions by which those who have done work and furnished materials to contractors may, to a greater or less extent and upon certain conditions, file a lien, commonly known as a mechanic's lien, against the property for the erection of which the materials were furnished, and recover from the owner the amount left unpaid by the contractor. Consequently, the owner generally requires of the contractor a bond conditioned not only to complete the work but to protect him against liability for labor and materials furnished to the contractor. In some cases, however, a contractor is required by law to give a bond which contains a direct obligation to pay all bills for labor and materials, and under which laborers and furnishers of material have a right of action directly against the surety. The underlying principle of mechanic's liens is that a man ought not to be permitted to have the benefit of the labor or material of another without paying for it. Where the owner of the property orders the materials, the application of the principle is quite simple, but where the work is let to a contractor and he orders the labor and material, the matter is more complicated, for the owner may, in effect, be required to pay for the materials twice, once to the contractor and again to the furnisher. The difficulty in applying the principle has resulted in different laws in the different states with little or no uniformity, although with some similarity. There are at least three different aspects in which this subject is presented. First, as a general rule, public property, that is to say, property belonging to the United States, or a state, a county or a city, is not subject to mechanic's liens, and a statute which provides in general terms for such liens is not ordinarily construed to provide for a lien on public property. In order that those who furnish labor and material for public work may have the right to lien on the property, or to recover from the contractor's surety, there must be a statute which in express terms gives such right. There are, however, a number of such statutes. An act of Congress provides that one who contracts with the United States shall execute the usual penal bond, with the additional obligation that the contractor shall promptly make payments to all persons supplying him labor and materials in the prosecution of the work provided for in the contract. The persons supplying labor and material are given a right of action under the bond directly against the surety, and are not required to establish any lien by filing a claim. A similar law exists in some of the states with respect to contracts for public work. In some cases, a separate bond is required, and in others, the additional obligation is contained in the regular contract bond. Where such direct liability exists, a breach of the contract on the part of the owner, such as an overpayment to the contractor, or a material change in the contract, would not affect the liability of the surety, so far as the payment for labor and materials is concerned, and since there are no details as to giving notice, filing claims, etc., which the claimant may omit to perform, it is fair to assume that, where such direct liability exists, the surety will be compelled to pay every bill which the contractor fails to pay. Second, in the case of contracts for private work, there are two principal classes of laws. One class, which follows what is known as the Pennsylvania Rule, provides that the laborers and furnishers of material shall have a lien on the building and the land on which it stands for whatever may be due them for labor and materials furnished for the work. In order to perfect such a lien, they must generally file in some court, within the time and in the manner required by law, a detailed statement of their claims. In some cases the lien may be enforced in an action directly against the surety, but in most states, the lien is enforced only against the property and its owner, and the owner is left to his remedy against the surety. The fact that it is necessary for a claimant to perfect his lien by filing his claim within a certain time and in a certain manner and form sometimes operates to relieve the surety from a liability, for it sometimes happens that a claimant does not perfect his lien, either because a lien for the particular labor or materials cannot be had, or because he did not suspect, until too late, that the contractor would fail to pay, or because of some negligence on the part of himself or his agents. Third, the other main class of laws, which follows what is known as the New York Rule, provides that the lien shall attach only to the unpaid balance of the contract price due by the owner to the contractor after the contract has been completed, so that if the owner pays the entire contract price to the contractor, in compliance with the contract, the claimant can recover nothing, or if the contractor defaults, and the owner is required to complete, the claimants are entitled only to the balance of the contract price, after the cost of completion is deducted. In such cases, the right to the lien does not affect the surety's liability at all, and may be ignored, for, if the owner makes his payments in strict accordance with the contract, he cannot be held liable for more than the contract price, and therefore the surety will be liable for nothing. If, on the other hand, he overpays the contractor and thereby incurs a liability for liens, he, by that very act, releases the surety from all liability. The only obligation of the surety is to pay the expense of having the liens removed from the record. Sec. 116. Limitation of liability by conditions in the bond. In perhaps the majority of cases, surety companies are permitted to issue their own forms of contract bonds, and those forms generally impose certain limitations and restrictions upon the liability of the surety and give the surety certain rights it would not otherwise have. The bonds of the several companies, although by no means uniform, usually contain, among others, provisions to the effect, 1. That in the event of default on the part of the principal, the surety shall have the right, at its option, to assume the contract and to sublet or complete it, and, 2. That the surety shall not be liable for any loss or damage resulting from mob, riot, civil commotion or a public enemy, or from strikes or labor difficulties, or from accident, fire, lightning, tornado or earthquake. The first provision is a valuable one because, in many cases where the owner is permitted to complete a job on which a bonded contractor has defaulted, he will interpret the specifications very liberally in his favor, and will likely expend considerably more money than the contractor would have done, and may therefore impose upon the surety company a loss it would not otherwise have sustained. It will be seen that where the liability of the owner is limited to the amount of the contract, that is to say, where the surety is liable for any excess over that sum, and where the owner is permitted to carry out the contract and interpret the specifications, he is apt to be rather liberal with himself. The surety is helpless because it is seldom, if ever, possible to show that the owner has done a better job than is specified. The second provision is also valuable, in that it relieves the surety from the chance of loss on account of extraordinary hazards. It is proper that the surety should be so relieved, as they are not proper risks for a surety company, and the owner should protect himself by proper insurance. The premium paid to the surety company for the bond does not enable it to purchase such insurance nor to take the risk of such a loss. In some states, it is necessary for contractors to give a statutory form of bond in which the surety is not permitted to impose any limitations upon its liability as fixed by the contract and specifications. And in some cases, the owner will not accept a bond that imposes any such limitations. In all such cases, it is particularly important to see that the contract makes proper provision for the protection of the contractor and his surety from extraordinary hazards, or that adequate protection is provided by insurance. Otherwise, more than the usual caution in issuing the bond is necessary. Sec. 117. Where contract antedates the application for the bond. The fact that a contract bond is applied for a considerable time after the signing of the contract is a suspicious circumstance which should be carefully investigated. It may be an indication either that the contractor has made application to other companies for the bond and been rejected, or that he started the work without bond and that the owner, finding he was not making satisfactory progress, or that he was not paying his bills, decided to require a bond. The result may be that to execute the bond would be to assume a liability for a defaulting contractor. In such cases it is advisable to require a full and satisfactory explanation of the delay, and, if the delay has been for as much as 2 weeks, to require of the owner a certificate to the effect that the contractor is not in default and that there is no more reason for requiring the bond than there was when the contract was signed. This is not a merely theoretical danger. The records of surety companies will show that they have been thrown almost immediately into severe losses by not observing this danger signal. It is difficult enough, when every precaution is taken, to discover the contractors who are attempting, by false statements or other means, to get bonds to which they are not entitled, so that it is important to consider carefully every indication of danger. Sec. 118. The underwriting of supplementary contract bonds. While the great majority of contract bonds are written in connection with building contracts, yet a considerable number are required to guarantee merely the future delivery of merchandise. Such bonds are known as supply contract bonds, and the term is limited to cover contracts only for the delivery of the merchandise and not those requiring the contractor to install it or to do anything other than deliver it. In underwriting these bonds, the general principles heretofore outlined for the underwriting of building contract bonds will in the main be applicable. However, supply contracts generally require no especial skill, and payments are usually made promptly upon delivery of the merchandise so that the capital is not tied up for a long period. The risk is therefore not as hazardous as on building contract bonds, and a man may be permitted to have on hand perhaps 2 or 3 times as much work as would a building contractor with the same resources. The adequacy of the price is perhaps the principal question to be determined, and, as in the case of building contracts, it is necessary to examine the other bids, if any, and to get all available information on this point. So far as the adequacy of the contract price is concerned, these contracts are presented in 4 aspects. In the first place, the applicant may be the owner of the merchandise which he has agreed to sell and deliver, and may be holding it for that purpose. In that event, there is little chance that he will fail to comply with his contract, and the risk is not ordinarily very hazardous. In the second place, he may be the owner of a factory which is producing merchandise like that required to be delivered. In that event, the continuance of the factory is the principal consideration, and that will depend largely upon the financial standing of the applicant and the length of time intervening before the delivery is due. In the third place, the principal, although not actually the owner of the merchandise, may have an option to purchase it at a lesser price than that at which he has agreed to sell it, so that the sale will bring a profit. If the option contract is with a responsible party, the bond in this case would likewise not be very hazardous. But if the principal intends to purchase the merchandise in the open market at the time delivery is due, the transaction is a speculative one and the bond should not be signed unless the principal is of such financial responsibility as to justify the expectation that he will be able to stand the loss in case the market for the commodity should rise. The probability that it will rise will of course depend upon the character of the commodity and the length of time between the awarding of the contract and the date of delivery. Where the applicant is in the habit of signing contracts for the future delivery of merchandise and taking the chance on the rise of the market, it is suggested that he ought not to be permitted to have on-hand contracts in excess of 10 times the amount of his net available resources, the case however depending upon individual circumstances. Sec. 119. The underwriting of maintenance bonds. Contractors are sometimes required, not only to do the work covered by their contracts, but to guarantee the wearing qualities or efficiency of the whole or a part of it. The wearing qualities of streets, roads, bridges, roofs and the like, and the efficiency of heating, filtering and other plants are among the subjects of such guarantees. Bonds covering these maintenance guarantees are, in their nature, essentially hazardous, because, in the first place, there is no means of knowing that the road, street, bridge or roof will last during the stipulated period, or that the heating or filtering plant will do what is expected of it, and, in the second place, the financial responsibility of the principal, at the time the bond is signed, is no satisfactory criterion by which to determine what it will be at the end of the maintenance period, for he may not only become insolvent, but may die and his estate be distributed to his heirs, or he may go to parts unknown, or may go out of business and dispose of his property. 5-year maintenance on street paving is the most frequent subject of maintenance guarantees, and, when such bonds are applied for, the whole proposition should be carefully considered, as such guarantees are particularly hazardous, unless conditions are exactly right, and collateral security is generally necessary. The risk that is necessarily involved in such a guarantee is great enough, but it is well known that in nearly every city there are a number of contractors who have sufficient political influence to so blind the city inspectors that they will permit inferior workmanship and the use of inferior materials, and some cities and towns, particularly the smaller ones, in order to save expense, will sometimes specify an inferior pavement and nevertheless expect a 5-year guarantee. In order to determine the conditions under which pavements may be expected, with slight repairs, to last 5 years, and to determine the amount that will be required to make those repairs, it is not necessary to be an expert paving engineer. There are only a few points that need be considered by a surety underwriter, and for practical purposes, a layman can pass on these as well as an engineer, although of course the advice of an engineer is always advisable. There are 2 cardinal rules which should be observed in all cases. 1. No pavement should be guaranteed for 5 years unless the bed of the street is well drained. If the subgrade is soft or wet, the pavement will not stand under heavy traffic, even though there may be a good concrete foundation. Maintenance guarantees should be avoided in all cases where the particular street or any considerable portion of it is below the water level or where the subgrade is not perfectly drained. 2. No pavement should be guaranteed for 5 years unless it is to be laid on a concrete foundation and unless the concrete is to be 6 inches thick, on streets where the traffic is heavy and 4 inches where the traffic is light. The usual mixture of 1 part of cement to 31/2 parts of sand and 7 parts of broken stone or gravel is satisfactory. A dry subgrade and a good concrete foundation are 2 absolute essentials to a good pavement, and unless a pavement is up to the standard in these 2 respects, it cannot be expected to last 5 years. If it is up to the standard, it is then necessary to consider whether or not the surfacing is satisfactory. The requirements for the different paving materials are different, so we must consider them separately, but it is not necessary to go into details, regarding which there may be a difference of opinion among engineers. It is necessary only to consider the particulars wherein a variation from standard specifications will materially affect the wearing qualities of the pavement and will mean a noticeable reduction in the cost. 1. Granite block or stone block of standard quality and size, if laid on a foundation as above stated, will, with very slight repairs, last 5 years, and 5 cents per square yard is sufficient collateral. In this pavement, a bituminous filler is satisfactory. 2. Creosoted wood block, of standard quality, with bituminous filler, if laid on a foundation as above specified, will last 5 years, and 5 cents per square yard will generally be sufficient to make all necessary repairs. 3. A pavement of vitrified brick is one which may or may not be satisfactory, depending upon the character of the brick and of the filler. In order to determine whether or not brick of this kind is of standard quality, it is customary to subject it to the Rattler test, and if, in the test, it loses more than from 20% to 22% of its weight, it is considered defective. It has been found that brick which will not meet this test will not last, and it is a fact that hardly more than 25% of the brick manufactured will meet this test. The other is rejected by the larger cities and are sold to the smaller cities and towns where the test is not applied. In order to make a first-class pavement, it is necessary not only to use good brick, but also to use grout filler, a thin mixture of cement, sand and water. It has been found that the smaller cities, in order to save expense, sometimes use a bituminous filler, but it is not satisfactory. The following collateral requirements are suggested. A. If the brick is to be tested and grout filler is to be used, 5 cents per square yard. B. If the brick is not to be tested, 10 cents per square yard. C. If grout filler is not to be used, 10 cents per square yard. D. If neither the brick is to be tested nor grout filler to be used, 15 cents per square yard. 4. Sheet asphalt may be of Trinidad or Bermuda's natural or Mexican or California refined asphalt. It should be laid at least 11/2 inches thick on a binder 11/2 inches thick. In that event, and if the foundation is as above specified, 10 cents per square yard will be sufficient collateral. If a cheap grade of asphalt is to be used or if it is to be less than 11/2 inches, collateral at the rate of 25 cents per square yard is necessary, as in that event, a large portion of the pavement will have to be replaced within 5 years. 5. Bituolithic pavement is a patented article controlled by Warren Brothers Company of Boston, and can legally be laid only by them and their licensees. When so laid, it will generally last 5 years, and since the indemnity of Warren Brothers Company, which is a very strong concern, is generally given in connection with maintenance guarantees on this pavement, such guarantees are considered safe. 6. Asphaltic macadam, bituminous macadam and bituminous concrete are different names for the same thing. It is very similar to bituolithic and is said to be an infringement of Warren Brothers' patent. However, when laid in accordance with the Topeka specifications, it is said not to be an infringement. This is not a very expensive pavement and is being used more and more. Some engineers predict that in a few years it will be used more than any other pavement. The wearing qualities of this pavement cannot be determined from the specifications, because so much depends upon the manner in which it is put down and it is so easy to deceive the inspectors. Collateral at the rate of at least 25 cents per square yard should be required. 7. Concrete pavements, whether laid in a solid sheet or in blocks, have not proven satisfactory, and they should not be guaranteed without full collateral. This kind of pavement is very brittle and on account of the expansion and contraction, is apt to crack and go to pieces in a comparatively short time. It is hardly necessary to add that macadam pavements, whether they are to be covered with oil or tar or not, should not be guaranteed without full collateral. Collateral as above specified has been found reasonably sufficient to make the repairs that will be necessary in the different pavements during 5 years, and it is not within the scope of this book to say when, if ever, these collateral requirements may be waived. However, they should in no event be waived except on stone, granite, wood block, and vitrified brick, and on sheet asphalt when the asphalt is to be at least 2 inches thick, and they should not be waived unless the pavement is to be of the highest standard above specified, nor should they be waived unless the applicant is very strong financially, has been in business for a number of years, bears a good reputation and is not suspected of receiving favors from the city inspectors in the shape of permission to lay an inferior pavement, and unless the indemnity of 2 or 3 persons worth 2 or 3 times the value of the work to be guaranteed is received. In the case of stone, granite or wood block or vitrified brick, the company furnishing this material should be required to agree to replace any that may be found during the maintenance period to be defective. It is not practicable to go into the matter of maintenance guarantees in greater detail, but as a general proposition it may be said that, on account of the probability that the principal will die, move away, or become insolvent, there are few cases where a surety company would be justified, without collateral, in executing a maintenance guarantee for as much as 5 years, although a guarantee of 1 year, or even 2 years, may often be made. All such guarantees should be passed upon by the company's engineer. Efficiency guarantees are, in a sense, more hazardous than maintenance guarantees, because, if the thing guaranteed does not come up to the requirements, it is generally necessary to replace it, so that the whole penalty of the bond will likely be consumed. Generally, however, the liability will accrue within a short time after the bond is executed, so that the financial standing of the applicant is not likely to change in the meantime. In this connection, it may be well to call attention to the fact that there may be a delay in testing heating plants, unless proper provision is made. The specifications for these plants generally call for a certain temperature in zero weather, or so many degrees below zero, and if that temperature is not reached the first winter, it may be contended, after the lapse of several years, when the principal has gone out of business, that the plant does come up to the requirements. It is therefore advisable to limit the guarantee to 1 year. This is not a hardship on the obligee, as it can be determined, on the basis of percentages, whether, as a fact, the plant will heat the building in colder weather,